Hello folks, Brett Ellis with the Ellis team at Keller Williams down here in sunny Southwest Florida, and we've got a market alert for you that we think you might want to pay attention to. So this past week we wrote an article for the news press talking about lock interest rates now before the big rate increase is coming at the end of the month. So I watched this financial guru on video this last week. His name's Barry Habib. He's a guy I trust because he's been very upfront and correct a lot of times. And so based on what we know now, he's got 3 reasons why interest rates could be headed for another big increase by the end of the month. And I want to talk about how that impacts you, but let's first talk about his reasonings. The first is quantitative tightening. The Fed started last fall and they're continuing that process, so they're buying less mortgage bonds and securities. When that happens, there's less buyers. That makes interest rates go up, and that's what the 10-year note kind of feeds off of, and that's what drives interest rates. The next thing to be careful about is the stock market. The S&P is past its 200-day moving average. So we're poised for a change right now. Now we've got these trade war things going on that's impacting the market. That's maybe the one wild card. But with the stock market down, it's poised for a gain. As the stock market, and specifically that S&P 500 comes up, that's where you can see a move to the bonds. So the yield goes up on the bonds as the price comes down, and when money goes into the stock market, it comes out of the bond market because they're more attractive, and we could see a move that way as well. And that's kind of his point. And the third issue is inflation. So we know the Fed is talking about they're worried about inflation going up. They're not worried, they just know what's going to happen. But he talks about the one thing that nobody is focusing on, but they're going to at the end of this month. It's called the personal consumption expenditure. Now, it gets reported 12 months at a time. March of 2017, according to Barry, was abnormally low. This March is going to come in higher when it's reported at the end of April. And when it does, the bond market is going to freak out and say, what's going on? We're used to seeing that PCE index at around 1.5%. Now it's up around 2%. The freak out changed the bond market, and then your yields go up instantly. So for those 3 reasons, there's compelling evidence that we could see some interest rate increases in the markets at the end of April. Now the Fed has already said 2 more rate hikes this year and 3 next year, but the 10-year note doesn't necessarily feed off of exactly what the Fed says. They go by more what the bond market does, and these 3 things, in addition to what the Fed has said, could drive the market, and we could see that at the end of April, and nobody's talking about this. So how does this impact you? I know it's a lot of stuff here. If you are a seller, you might want to have your home on the market now and priced attractively, because we're already seeing a fall off with some buyers. These rate hikes are affecting them. They're at 4 5/8 right now, and I've heard they may go to possibly 6% by the end of the year. The end of April, this could all start happening. Any 1% increase in interest rate takes about 11% purchasing power away from the buyer. So in the article I talk about, let's say you have 100 buyers for your property now in your pool of buyers, and just take away 10-15% of those buyers, and now you're down to 85. Now keep in mind, for those 100 buyers, there might be 130 properties. So every property is not going to find a buyer. And now, when interest rates go up, there'll be maybe another 15 that won't find a buyer, just because the buyer pool shrunk, because it's not like their income shrunk, but the increased interest rates just took away buying power from that person. So it hurts you on the selling end. The other thing is, a lot of sellers, when they sell, they end up buying another property. And what we find is it hurts them too, because by waiting to try to get that extra dollar in the sale, which may not come, but even if it does, it can eat you alive on the buy. If interest rates are 0.5%, 1/4%, 3/4% higher over your 15 or 30 years, you're going to pay way more than you're trying to save or accomplish by waiting a few months of the sale of your home. So I'm telling you people, it's time to get going. These rates are real. They've been happening. It's been impacting the market a bit, and the bigger impacts are coming, and they may start coming as soon as the end of April 2018. So whether they happen in April or May or June, they are coming, and there's compelling evidence that they may start coming in April of 18, and you heard it here first. So you've been watching The Future of Real Estate, presented by the Ellis team at Keller Williams Realty in Fort Myers, Florida. If you want to read more about this article, go to our blog. You'll see this article right there, blog.topagent.com. And if you want to search the MLS, find your dream home, or even find out what your property is worth, go to leecountyonline.com, and on the right side of the screen you can find out what your property's worth. You can search all the properties, or just give us a call, 239-489-4042. If you want to list your property, ask for my mother Sandy or myself, Brett, and we'll take good care of you. And thanks for tuning in to The Future of Real Estate.